Hey everybody, good afternoon or good morning, I guess. My name is Brent Moores. We're talking about long verticals today. So I'm sitting in for Cameron May, who's the regular instructor of this class. Cam will be back next week, I think. I know he's been out a few weeks, I think, but next week you get Cam again. But today we're talking about long verticals and I think some key concepts related to long verticals. It's good to see you. Our friends out there and those of you who are watching on recording, glad to have you here as well. I'm joined alongside by Mr. Kevin Horner, and he's helping me out in the chat. Of course, those of you who aren't familiar with it, each day at 9:30, each weekday at 9:30 a.m. Eastern, we have a Trader Talks webcast that Kevin teaches. Wonderful way to start your day. So make sure you check that out, live or on a recording. Now you can follow Kevin or myself on X at Brent Moores CS, at Kevin Horner CS, and yeah, additional content there on X. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation of any security strategy or chart pattern. Schwab does not recommend the use of technical analysis as a sole means of investment research. And paper money application is for educational purposes only. And for the sake of simplicity, we may not factor in commissions or fees on these examples that we use today, but just realize that they're something you should think about. Investing involves risks, including the potential loss of principal. That's one reason people do diagonal spreads, is to hopefully try and limit the risks there in the trade. And we're going to talk about that just a little bit more. And past performance of any security or strategy does not guarantee future results or success. I'm just glad to be here, folks. So let me bring up my Thinkorswim platform because I want to talk about vertical spreads today. And I'm going to use some examples. And the examples I picked are actually some examples that I generated from a scan that I taught about a week ago, or maybe a couple weeks ago, on flag patterns. And if you're interested in that webcast, I'm going to throw a link to that webcast in the chat for those of you who are watching it. It's one that I did in my long options webcast, not this week, but I think it was last week, so it would have been last Tuesday. Long options webcast, and it was called Scanning for Flags or something like that. So if you're interested in these scans that I found these stocks with, that's where you can see more about that. But also just realize if you're looking for trades, potential trades to consider, you can just use any liquid list of stocks that you're interested in. Liquidity is the key with options. There's some other keys here. And, you know, when we talk about options, let me just kind of talk about with verticals. There's just a few kind of major considerations that I want to talk to you about here today. One is, if I want you to consider the probability of the trade, the probability, and I'm talking about long verticals here, okay, long verts. Although these concepts can apply to other types of option trades, but that's what we're talking about today, long verticals. And I want you to consider what the risk reward aspects of the ratio. So probability and profitability. For probability, there's kind of there's one main thing that we're going to consider here today that we're going to look at. Where's the break-even point on the trade? Where's the break-even point on the trade? There's two other things we're going to really consider here today. One is, what's the max gain on the trade? You should always know what the max gain is on a long vertical. And then the other, you may be able to guess here, is what's the max loss on that long vertical? The first one, the break even, speaks to the probability of the trade. The next two, the max gain and the max loss, speak to the reward to risk ratio. So these three elements here, break even, max gain, max loss, are ones that you want to consider. And depending on what strikes you choose on your long verticals, that's going to determine all three of these things. break even, max gain, max loss. Okay, so we'll go through some examples here on that, but that's the first thing I wanted to mention to you today. Okay, so I'm going to start off with, we'll give you bullish and bearish examples here, but this is kind of, I'm going to consider this kind of a flag pattern here right now. The general trend has been up on this stock. It went up like this. It's kind of pulled back a little bit, and now we can wait for it to break out, put a little X for a breakout there and get in. Or if we want to be more anticipatory and say, look, I'm looking to get in now, I'm not going to wait for that breakout. The classical entry on a flag pattern is to wait for that breakout. But let me just show you initially how to set that up, because when we look at this trade, if we choose strikes, now with a long call vertical, we're going to buy a call. I'll put BC for buy a call, and we're going to sell a call at a higher price. Okay, and show this is going to be a short call or sold call. If I choose a strike price, say down here and down here, if my strike prices are down here, down below where the current stock price is, then my break even is going to be lower. Okay, my break even is going to be down in this range somewhere. Okay, and so that's going to increase my probability, because even if the stock goes sideways, we're doing fine on that probably, because we'll be above our break even point. But my max gain is going to be less and my max loss is going to be more. Okay, so that gives me a better break even profile, but a worse max gain or max loss profile, or reward risk profile. To the other, and we'll look at examples here in a second. Another case, if I put my strikes up here, say my long call here and my short call up here, where they're all above the current stock price, my break even is going to be way up here. Okay, my break even is going to be way up here. That gives me a worse probability of success, but a better reward to risk ratio. It's just a balancing act on those. Okay, and of course, probably more often than not, as I teach it in these classes, is I'm going to put them kind of in between. The stock price is going to be in between my strike prices. So let's just take a look here. So I'm looking for a bounce here on this. The stock right now is about 175. Let's do like a 170, 180, where the stock is in between. Stock's at 175, 170, 180, and just kind of look at those factors that we have. So, and I'm going to go out, we'll go out about a month here. So we'll go out 29 days, and I'm going to do a 170, 180. So I'm going to buy the 170. I'm just going to click on that ask price. I'm going to sell the 180. I'm going to control click on the bid price, and that is a long vertical spread. This is a bullish trade. If I click on confirm and send, I'm not going to send it right away, but it's going to give me that break-even stock price. Break-even stock price is roughly about where we're at here right now. Okay, and here's my max profit and my max loss. I would only do this trade if I'm bullish on this trade. Now, let me edit this. If I were to switch this and say do a 175, 185, look what happens to it. 185, 175. Now if I click on confirm and send, and I look at this, my break-even stock price has moved up. I've moved those strikes up. My probability of success is less, because the odds of it going above 178.60 are less than the odds of it going above 175.60 or whatever it was. But now look at my profit loss. It's improved there. It's better. So anytime you do these trades, you have the choice. You have the power. If you're more bullish, more aggressive, you can use higher strike prices. If you want to be a little bit less aggressive, in other words, in terms of make it a little bit of a higher probability trade, you can use lower strike prices. In this case, what I'm going to do here is I'm going to go back to the original, which was 170, 180. Now, I could just enter this trade right now if I wanted to, or I could say, I only want to get in if we get that breakout. Well, I'm going to call the breakout. I'm going to zoom in here just a little bit. I'm going to say that breakout is going to be above the high of where today is right now. So the high today right now is at 177.50. Where did I get that number? I got that number by looking right up here at the top of the page where it says H, and I'm putting my cursor on the candle that I'm looking at, and you can see next to that H, it says 177.50. All right. So that's, I could put that in. Now, if I get in then, not now, now it's 175. If I get in when it's at 177.50, look, things will have changed a little bit. My strikes of 180 and 170, no longer is the stock going to be kind of mid-range between those two. We're going to be up closer towards the upper end of things. And that means my break even is going to be a little bit higher, but my reward to risk is going to be a little bit lower. But if I want to do that trade, let me show you how to do this. Let me go back to the trade page. And if I wanted to just enter that only if the stock goes above 177.50, I can change this order from limit to market, can make it good till canceled. I can click on the gear and I can say, I'm only going to do this if PM marks greater than or equal to 177.5. Okay, so that would be that entry there on that. That would only get me in there. Now, there's a question from Chuck in the chat. Chuck said, once you put on a trade on a long vertical, and several days later you see the stock has hit your target, how do you close the order before the expiration date? Well, I'll show you. I'll show you how to close these orders. Now, we can also put in an order right now to get out if the stock goes down. Let's say we're looking at this and we're saying, hey, look, I'm banking on this stock to bounce. But look, I'm going to call this kind of a support level if it bounces. Okay? If the stock drops down below here, that's about 175. We'll give it a little wiggle room. I'll go down to about 173. If that stock goes below 173, I want to get out of this. I can go to advanced order, change it to first trigger sequential. Okay. I can then create an order to exit, which is just going to be an opposite order. This is an order to buy the 170 and sell the 180. If I right click on this and create an opposite order, it's going to be an order to sell the 170, that is the one that we bought, and in order to buy the 180, the one that we sold up front. In other words, that would get us out of the trade. And we can say, well, we're going to get out of this. I'm going to do the same thing, good till canceled, and I'm going to click on the gear. And in this case, I want PM to mark less than or equal to 170, whatever price you put. 172, I think, is what we said there on that. Okay. Let me just get that at 170, not 1720. I have an extra digit there. Click on save, and that's going to be an order to exit that trade if the stock drops down. Now, that's not Chuck's question. Chuck is, hey, what if I'm in this and I just want to get out of this at some point? Well, that's fine. Let's do that here. Let me confirm and send this. Okay. And I'm going to, let me put this in my long verticals group. We'll click on send and now that's not going to fill right away because this is contingent upon that bounce. But let me go to long verticals here for a second because I think I have another one here. Here I have CRM and, I don't have anything in that. That's not one. Well, hold on one sec. We'll do another trade and I will show you, Chuck, how to get those out. Okay, get out of those if we decide to. Let's do maybe a little bit more of a bearish one. This is going to be a bear flag trade. So I'm going to do a little itty bitty company you may have heard of called Apple. So here's Apple, kind of the same principle, but in the other direction. Trend has been down. We've had lower highs. A little bit of a retracement. Looks kind of like a bear flaggy type retracement. Bouncing off the 20-day moving average, the 50-day moving average. I'm just going to look to get in this trade. Now, remember, we'll look at some of these, we'll look at actually entering the trade here in a sec. Right now, the stock's about 201 right now. If I put my strikes here and here, in other words, my long put here, my short put here, that is going to be a higher probability trade, but it's going to be a lower reward to risk trade. If I put my long put here and my short put down here, it's going to be a lower probability trade because it's going to need to move farther to get to my break-even point. But my reward to risk ratio will look a lot better on that. But in this case, again, I'm going to do something kind of in between where we're at, and we'll do that. So the stock's about 201. Let me go to the trade, and we're on Apple. Now you can go, you don't have to go out a full, I went out a month on that other one. You can go out more days or fewer days on that. And let's take a look. Let's take a look at it. Let me go and I'll go out 22 days here on this. Okay. So now I have strikes every $2.50. I'm going to look at the put side of the equation here. And I'm going to go to the 202.50. I'm going to buy that one by clicking on the ask price. I'm going to go to the 197.50, or should I go to the 195? It's how bearish I think I am. If I think it's realistically a good chance it's going to go down to 195, I'm probably going to choose the 195. If I think that's a stretch and 197.50 is more likely, I'll probably choose the 197.50. Well, if this bounces down and does kind of a normal flag pattern, yeah, 195 certainly seems attainable down there, okay? That's where some of these recent lows were, close to it at least. They were a little bit below that. So that's right about 194, we'll say. That's where those, that seems very reasonable to me. So in this case, for our example trade, I'm going to do that 195. So do you see when you're picking strikes, choose what's a realistic level you think the stock may go to. Yes, I can do the 185. That may make it look better from a, give me more potential gain on there. My max gain may be better. But if you don't think realistically it's going to get to 185, then don't choose that because the trade is going to be more expensive. Remember on this, when we're buying this, let's say we buy the 202.50. That's a debit right there, 675 debit. The net cost of the trade is going to be that minus whatever my credit is. That's the contract I'm going to sell. So if I choose that 195, we'll say 360, my net cost of that trade is about $3.15, I think, if I'm doing my math right there, okay? If I go farther out of the money, go to the 190, then the net cost of my trade is going to be 675 minus 234. That may move around just a little bit and is going to equal 441. Am I doing my math right there on that? But you get the point. It doesn't matter exactly. It's going to be a more expensive trade, but I have more potential gain if I do the lower strike on that. So that's so that goes back to know what your max gain is, know what your max loss is, and know what your break-even point on these is. So I'm going to go here, and I'm going to sell this one. I'm going to hold down that control key. Now, before I do that, though, just think about this. You always have a choice of trades. You have a choice to trade. You have a choice not to trade. Okay, fair enough. You have a choice to say, look, I'm willing to give up. I showed you already, if we go down to a lower strike price on this, then it's going to cost me more and more. The logical extent of that is not even to use a lower strike price and just simply buy the long put there. That's fine, but that's not a long put vertical. That's a type of trade that we talk about in our long options class I teach on Tuesdays at 1 o'clock Eastern time. But the reason we're doing this is to try and lower the cost and lower the max loss, because your initial debit is your max loss on that. Okay, so let's do this trade here, and I'm just going to put this in, and we'll show you how to close it out. Let's see, we said 190. I think I actually put the trade in. There we go. And when you put in a vertical spread, it's going to put in at the mid price. Spreads on Thinkorswim get inputted at the default is at the mid price. Okay. Single options, if I just do a long call or a short put, single options are going to default to the natural price. Now you can tweak these. Getting filled at the mid price may be kind of tough, but you don't have to go all the way to the natural price necessarily. If we move off that a little bit, that may make it a little easier to get filled on that. So I'm just going to confirm and send this, and I'm going to put that in long verticals. Okay, there we go. So we just did that. We filled that, and fills on paper money aren't necessarily going to be the same as your fills in real life on your live platform. So just sometimes you may need to tweak the price a little bit more in real life versus the paper money, but who knows? They do a pretty good job. Okay, let me hit some questions here in a sec, but let me first hit the first question, which was, how do we close these out? If you go to your category here, here's Apple. Here's the trade we just barely entered, okay? And let's say we wanted to close it out. How would I close it out? Well, you can right-click on it, the symbol, and then it gives you these choices if you go to create closing order. There, I can get out of this. This is going to say I can sell this right here. And again, it's a spread. It's putting it at the mid price. I may need to go a little bit below this. And then I would just confirm and send that order. Okay, so I'm hoping that answers your question there on how to close that out if you want. Now, if you do this, sometimes this isn't this trade. You can click on the symbol itself, and it knows I have a vertical spread on here. So, but it gives me the choice. Vertical, or it says, well, maybe you just want to get out of one leg or the other. That's just to get rid of the short leg, to buy back that leg, or this is just to get rid of the long leg, but this is to get rid of both. Another trick, if you have a multi-leg option, by the way, and this is a little bit outside the scope of this class here, but if you want to close out, and let's say you have something with several legs in there. Oops, that's not the one. Let me see. Several legs in there, and I want to just pick the ones. I can click on it. Sorry, you can click on it why is that not letting me do that? I can hold down the control key. It should. I think it's because I have these grouped. Why is it making me do that? I think it's because I have these. One quick sec here. Let me just. Let me just look one more time at this here and see. It's going to let me do. Yeah, I don't know why. Sometimes you can click on individual legs. I've been fiddling with the grouping on these, and it's not letting me do that, but you can hold down your control key and just pick individual contracts there on that. Anyway, I don't want to get sidetracked too much on that trade here. Let me hit other questions here. Martin said, Okay, so good question. So, and Kevin answered that question, but I'm also actually going to address this for everybody because it's a common question that people have. In this case with Apple, I demonstrated a long put vertical spread. Okay. Now, some of you are probably thinking, hey, look, I've gone to the short verticals. In fact, we have a short verticals class later today, I think, this afternoon. Yeah, 2:00 Eastern time. When would I do that versus a short call vertical spread? Right? Because they're pretty similar. They're both bearish trades. The long put vertical is a debit spread. Okay. The short call vertical is a credit spread. And one difference is in this case, well, some people like to bring in that credit. Some people just have a preference for the credit spread. But let's say we're doing a contract. Let's say we do a 200 and 210 strike. Okay, just as for an example, 200 and 210 strike. And I'm doing a short call vertical. That would mean I would be selling or doing a short call at the 200 strike. I'd be doing a long call at the 210 strike. And look how close we are to being in the money here in the case of the short call vertical. We're just basically right at the money. And remember, short options can be assigned early, okay? And so they can be assigned early. And so often what we don't want to do is we don't want to increase the odds of early assignment by letting that contract get in the money here. Whereas if I'm doing a long put vertical, and I'm doing these trades, I've got a long put. Sorry, I've just confused myself. If I'm doing a long put vertical, I'm more likely to keep those out of the money here in this if I'm expecting it to move down. So, for example, actually, I picked bad strike prices on that. Let me do it this way. Let's say we're more aggressive and we're doing the long put vertical here, and I'm going to do my long put right here. So I'm doing a long put here, and I'm doing a short put down here. This is a long ways away from being in the money in terms of my long put. Okay, in terms of my long put. It's possible, theoretically possible, I could get assigned early on that short put down here. That's way out of the money, but it's very unlikely. But in the case of a short call vertical, where it's going to have essentially the same strike prices, same profit loss potential, but in that short call vertical, this short call right here, if I do that, that is already in the money there. And so that's going to be a long call, short call. That short call is already in the money. So my odds of early assignment go up significantly in the case of that. So if you want the higher probability trade, very often what we'll do is, if you want a high probability trade and you do want to do a short call vertical, you can do it like this: short call, long call up here. It's unlikely you're going to get assigned early in that case unless the stock goes up a little bit. It's possible, but it's unlikely. But if you're going to, so in the high probability scenario, people will defer more towards the credit spread, in addition to getting the credit. But in the case of a long vertical, if I want to be more aggressive and I'm putting my strikes down here, I'm more likely to do a long put vertical to keep those contracts out of the money. We just kind of like to avoid the odds of early assignment on those. So hopefully that adds just a little bit more color to that on that as well. Okay, So let's see what we got. All right. Well, let's do some other. Let's look at some other examples here. Okay. So let's do one that's maybe a little bit more aggressive or a little bit less aggressive here. Let's pull up Dana here, and the general trend has been going down. And these verticals typically start with a trend, a technical analysis, right? And with technical analysis, we often start with a trend. Okay? You don't have to, you can do whatever you want. And then kind of a common thing is we'll look at support and resistance levels. In this case, I'd say, well, we've got some resistance here and maybe establishing more resistance, and maybe we're bouncing down here as a potential resistance. But number one, trend. And then we can look at other indicators and what like that. But in this case, remember, the first thing you're going to check is, where do you think this is going to go realistically? Well, I think realistically hitting these more recent lows is a realistic level for this to go. Okay. And so that's going to likely be my long put strike. My short put strike here in the case of a short put vertical. A long put vertical. So that's right around 180. I'm going to say about 182 or so. Okay. 182 is going to be my target. Now, we may not have a strike at 182, so we're going to go close to that. We'll see what we got. That's going to be my target. If I thought my realistic target was going to be down at 175, then I'd probably pick the 175 strike. What about the higher strike? Well, where I don't think it's going to go above. I think we're looking for it to bounce from where it's at right now. I don't think it's going to go above about 193. We'll give it a little wiggle room about 195. And that's going to be my long put in this case. So that's how I'm picking my strikes here in this case. And so I'm going to go to trade. I'm going to look at my strikes here. And I said, my long put is going to be about 192. I don't have 192, but I have 192.50. I can click on my ask price on that. Now, if I just did that trade, I'd be risking $710. If I just did that trade, my max profit would potentially be very high. But remember, that looks pretty good, but the reality is it's probably pretty unlikely Danaher is going to go down to zero here. So realistically, if I think it's going to run a long ways, I may just do this trade. But my break even here is about 185.40. Let's throw in the other leg on this. 185.40 was my break even just on the long contract. So I'm going to go down to, well, we said about 182. What did I do? Did I say 195 was my, I picked the wrong strike. 195 was what I meant to click on. So let me do that one more time. Sorry about that. Click on confirm and send. My break even is 186.50. My max profit is still very high. My max loss is 850. Okay. Now let's compare that to if we do the spread. On the spread, we said, well, I'm going to go down to the 182.50. I'm going to sell that. I'm going to hold down the control key. So instead of a max loss of $850, my max loss is $528. Okay. My break even, instead of my break even being down at 186, I've moved my break even up closer to 190 here on this. So by doing the spread, as opposed to doing the single option, my max loss cut down from 850 down to 528. My break even went from 186.50 to 189.70. I would say both of these are very substantial differences versus just doing that long put there alone. The downside is my max profit. My max profit is going to be reduced. Now, realistically, what I said is I don't think the stock is likely to go that much below 182, but I could be wrong. So there's always pros and cons on these. Okay, so there's that. Now, there's another question, and I want to address that. What about the implied volatility on these legs? You can look at the implied volatility on these legs. You can look at the Vega on these legs. But realize when you're doing a vertical spread, your option Greeks are the net of the two. In other words, if we did a 195, my Vega is 18. If I do the 182.50, my Vega is about 16. In other words, my net Vega is about 0.02. I'm not going to stress over a 0.02 net Vega on those, because compared to the magnitude of the impact of price movement, the impact of implied volatility is probably going to be pretty small on those trades there. Okay, so that's why I haven't been picking that out. That's a good that's a good question there, John. There. So, but if you expect big IV moves, yeah, you can do that. But just realize all your Greeks are going to be reduced significantly. Even the delta. If I did the delta, just did that 195, my delta was 62. By doing the spread, my delta is reduced, and it's just going to be the net of those, which is about 33, I think, if I'm doing my math right there on that. So it's a slower moving trade than if I just do that long call. Okay? Let's see. Let's see what we got here. So we'll put in the trade there. Question on why Danaher other than the technicals. This was based on a couple things. Primarily, it was the technicals. I think the implied question here is, what about the fundamentals on the stock? Look, this trade right here that we just are looking at is a 22-day trade. Most fundamentals, whether fundamentals are great or really bad, realistically, the fundamentals are probably not going to have a super big impact over a 22-day trade. Okay, that's why I'm focusing on technicals. Now, there is something else that we want to check, and that is, look, do we have an earnings date coming up? You can check that. Here, we just had earnings not long ago. So we don't have earnings in the next 20 days. Number two, you want to make sure liquidity is reasonable on these. These stocks are all S&P 100 stocks that we've looked at. And that is probably a pretty good starting point on liquidity. If you are concerned on liquidity on these, you can look at the monthly contracts, which tend to have a little bit better liquidity than the weekly contracts. Okay, so hopefully that is helpful on there. Furthermore, on this, if you do want to look at that implied volatility, you can, and you can see if you expect big changes in the implied volatility, even though the implied volatility effects are reduced because of the spread versus just a long option. If you do expect a major change in that IV, then that may be a bigger factor for you as well there. Okay? So there we go. I'm going to look, and we're going to look to enter that trade. And I can decide on my exit points here. Now, one thing is I can put in those exits. If you want to put it in and say, look, I want to get out if this makes a certain price. Right now, my entry price is $5.55. If I want to get out, if this makes, say, 80%, I could just go like 1.8 times that, and it's going to be it's going to be about $1. I could exit out, about $10. I could exit out on that, on the option price, or I can do it based on the stock, like I demonstrated earlier as well. So that's a way to do it. And I can also put in a stop loss. Maybe I put in a stop loss at half the price. Half of 560 is, let's see, what 250 plus 30 is 280. 280. So if I wanted to put an exit on here, I could do a first triggers OCO. I can right click on this, create an opposite order to get out. I'm going to do another one of those. Okay. So here's my exit orders on this. One is going to be a limit exit. In other words, if we hit this, we're going to get out. We said that was going to be $10. That'll get us out on that. I'm going to make it good till canceled. If I want to put in a stop, I'm going to change that to stop, good till canceled. And I'm putting in, for our purposes here, about half the price of my entry, $2.80. I can do that, and I can look here, and I'm going to we'll go to about that. And I'm going to confirm and send, and I'm going to, I got rid of my group, so I'm just going to send that and put that in, and we filled another vertical spread there. Okay. All right, folks. So let me kind of summarize here as I wrap up. When you are considering these trades, there are three major things I want you to consider. What is your max gain is one of those. What is your max loss is another one. What is your break-even point on those? Okay, those are the three main things. But also in light of that, let me just add a couple subcategories, and that is when you're picking these, something that's going to factor in these is realistically where you think the stock can go to. If you think the stock isn't going to get anywhere near a lower strike, then pick a higher lower strike on that. Okay? In case of the put, or in the case of a long call vertical, if you think it's unrealistic the stock is going to go up and hit that higher strike, then don't pick that higher strike. Pick a lower higher strike, one that is more realistic for you. But consider these not just for vertical spreads, consider it for other spreads. Consider it for short vertical spreads. Consider it for long calls, long puts, whatever other kind of trade you have. Consider these three items right there: max gain, max loss, and break even. Hey, I want to thank Kevin for helping me out in the chat today. Coming up next, we have our skipper session. So make sure you check that out. That's at the top of the hour. If you haven't tried one of those out before, they're good. They're really good. So make sure you check that out. And I think Cam's back next week, but let me just address one last question as we get out, because it's a good question. Harry said, is there any possibility both exit will execute and will end up short? That's why we did a first triggers OCO order, Harry. That should prevent that. The first triggers OCO should prevent us getting triggered on both of those exit orders. There is a survey link in the chat, by the way, everybody. So we'd appreciate your feedback on that survey. Just click on the link there and you can fill that out. And everybody have a great rest of the day. Bye-bye.